Forex Fundamentals and Trading. Chapter 14. Leverage and Margin. Section 1. How leverage works. Leverage increases exposure by letting a relatively small amount of your own capital control a much larger market position. Your money is still central to the trade because it serves as the collateral supporting that position. The broker is not handing you a pile of extra cash to spend separately. Instead, the broker allows your account to hold more exposure than your cash balance alone would permit. That matters because profit and loss are calculated on the full position size, not just on the amount you deposited. So if you have $1,000 and control $10,000 of currency exposure, even a small price move is applied to the entire $10,000. This is why leverage can make a trade feel much bigger than the cash sitting in the account. The leverage ratio tells you how much market exposure you control for each dollar of your own equity. At 2-to-1 leverage, every $1 of equity supports $2 of exposure. At 10-to-1, $1 supports $10 of exposure, and at 20-to-1, it supports $20. To the higher the ratio, the larger the position you can open with the same account size. That sounds attractive at first, but the ratio does not just describe opportunity. It also tells you how strongly your account will react when the market moves. Leverage does not make an asset more volatile. A 5% move in the market is still a 5% move whether you use leverage or not. What changes is how much of your account is tied to that move. If you simply invest $1,000 without leverage and the asset rises 5%, you make $50. But if that same $1,000 is used at 10-to-1 leverage to control $10,000, the same 5% rise produces a $500 gain. The exact same math works in reverse on the losing trade, which is why gains and losses both feel much larger. This is the part traders must keep firmly in mind. Leverage magnifies both directions equally. A $500 gain on a $1,000 account is a 50% return, which feels powerful. But a $500 loss on that same account is also a 50% hit to equity, and recovering from that is much harder than people expect. Higher leverage leaves less room for normal market noise, small mistakes, or delayed exits. Even a modest move against you can become a large percentage loss in the account. That is why leverage should be thought of as a multiplier of account sensitivity, not as a shortcut to easy returns. In a retail trading account, opening a leveraged trade usually happens through margin rather than through a visible loan deposit. You begin with the equity already in your account, choose the position size you want, and the broker checks whether your account has enough collateral to support it. If the leverage available is high enough, a relatively small balance can control a much larger trade. The basic idea is that position size is shaped by your equity and the leverage or margin rules attached to the product. Throughout the life of the trade, the broker continues monitoring risk through margin requirements. So a leveraged trade is really an agreement that your account equity will stand behind a larger market exposure. Once the trade is open, gains and losses are always calculated from the full exposure of the position. If the position moves in your favor, your account equity increases even though the margin requirement itself may not change much at first. If the market moves against you, the losses come out of your equity, and that reduction can happen quickly because the position is larger than your cash deposit. This is why traders often misunderstand what margin does. The margin is only the capital set aside to support the position, while the profit or loss comes from the whole position value. If losses become too large and equity drops too far, the broker may restrict new trades or close existing ones to protect the account. A worked example makes the scale clearer. Suppose a trader has $5,000 and uses 20-to-1 leverage. That allows control of a $100,000 Forex position because 5,000 multiplied by 20 equals 100,000. At that size, a 1% market move changes the position value by $1,000. Relative to the $5,000 account, that is a 20% swing from only a 1% move in the market. So even though 1% sounds small in market terms, it becomes very meaningful when leverage is layered on top. Using that same example, if the $100,000 position rises by 1%, the gain is $1,000, which is a 20% return on the trader's $5,000 of equity. If it falls by 1%, the loss is also $1,000, or a 20% loss on equity. Compare that with no leverage at all, where a 1% move on $5,000 would be only $50. The market itself did not behave differently in either case. The only thing that changed was how exposed the account was to that move. That comparison is the heart of leverage. Same market movement, very different account impact. The same principle applies outside Forex as well. If you have $10,000 and use 4-to-1 leverage, you can control a $40,000 stock position. At $400 per share, that means buying 100 shares. If the stock rises 3%, the position gains $1,200, which is a 12% return on your $10,000 of equity. If it falls 2.5%, the position loses $1,000, which is a 10% account loss. The asset moved only a few percent, but your account moved much more because leverage multiplied the exposure. The most common leverage mistakes come from looking only at the upside and ignoring total exposure. Traders often assume leverage is mainly a tool for improving returns, when in reality it scales losses just as efficiently. Another mistake is automatically using the maximum leverage a broker offers, as if availability means suitability. Many also focus on how little margin is required and forget to think about the full position size they are actually controlling. Costs, spreads, financing charges, and ordinary price swings can then become far more damaging than expected. The safer mindset is to start with exposure and downside risk, and only then decide whether leverage fits the plan. Section 2. Margin requirements. Margin is the portion of your own money that is set aside to support a leveraged trade. It acts as collateral for the broker, showing that your account can absorb some loss while the position is open. This is why margin should not be confused with a fee. A fee is money that is paid away and gone, while margin is simply reserved inside the account. If the trade is closed without those funds being lost through price movement, that margin becomes available again. So margin is best understood as committed capital, not as a cost of admission. Two margin terms matter most in practice: initial margin and maintenance margin. Initial margin is the minimum amount required to open the trade in the first place. Maintenance margin is the minimum equity you must keep in the account to continue holding that trade after it is open. In many cases, the maintenance requirement is lower than the initial requirement, which gives the trade some room to fluctuate. But if losses reduce your equity below that maintenance level, the broker may step in. That is the point where margin calls, trading restrictions, or liquidation risk begin to matter. Margin requirements place a limit on how large a position your account can support. The basic logic is simple. Required margin is calculated as a percentage of the position's full notional value. So if the margin requirement is low, the same amount of cash can support a larger position. If the margin requirement is high, your maximum position size shrinks. For example, $1,000 at a 2% margin requirement can support a $50,000 position, but at a 10% requirement, it supports only $10,000. This is why margin percentage and leverage are closely linked. Higher margin means lower leverage, and lower margin means higher potential exposure. Margin requirements are not fixed across all markets or all brokers. They vary depending on the asset being traded, how volatile it is, how liquid the market is, and how conservative the broker chooses to be. Major forward pairs often have lower margin requirements than more volatile products because their price movement is usually steadier and their markets are deeper. When volatility rises, brokers often raise margin requirements to protect against faster losses. During periods of market stress, requirements can change quickly and without much warning. That means traders should treat margin rules as something to monitor continuously, not as a one-time setup detail. A practical margin workflow begins with the notional value of the trade, not with the cash deposit alone. First, calculate the full position value you want to control. Then apply the broker's initial margin percentage to determine how much of your own money must be reserved. Once the trade is open, keep track of how much margin is being used and how much free margin remains in the account. After that, monitor equity as unrealized profits and losses change with the market. The key ongoing check is whether your equity remains comfortably above maintenance margin, because that is what determines whether the trade can stay open. Maria's example shows how quickly leverage can make a modest market move matter. Suppose she opens a Euros H trade for 100,000 units at 1,000.1,000, creating a notional value of $110,000. If the broker requires 3% initial margin, she must post $3,300 to open it. If maintenance margin is 2%, then she needs equity of at least $2,200 to keep the trade open. With a $5,000 deposit, she begins with some cushion, but not an enormous one. That is why even a fairly ordinary move in the currency pair can materially change the safety of the account. This example becomes more revealing when the market moves against Maria. If Euro USD falls from 1.1 thousand to 1.0800, the loss is $2,000. So her $5,000 of equity falls to $3,000. That is uncomfortable, but it still remains above the $2,200 maintenance threshold, so the trade can continue. If the pair drops further to 1.600, the loss becomes $4,000 and her equity falls to $1,000. At that point, she is below maintenance margin, which means the account is under-margined. The broker may then issue a margin call or begin liquidating positions to reduce risk. One of the most important clarifications in trading is that margin is not the same as maximum loss. Margin only tells you how much capital is needed to support the position at entry and while it remains open. The actual gain or loss comes from the full market exposure of the trade. If a leveraged position moves sharply against you, the posted margin can be consumed quickly because losses are calculated on the whole notional amount. In some cases, losses can even exceed the amount initially posted as margin. That is why traders must think in terms of exposure and downside scenarios, not just required margin. A stock example ties these pieces together neatly. If you deposit $10,000 and the initial margin requirement is 40%, you can control a $25,000 stock position. At $50 per share, that means a maximum of 500 shares. If the price falls to $40, the market value drops to $20,000, while the borrowed amount remains $15,000. That leaves equity of $5,000, which is exactly 25% of the new market value. So at $40, the account is right at maintenance, and any further drop would push it into margin call territory. Most practical margin mistakes come from misunderstanding what should actually be monitored. Many beginners treat margin like a fee, when it is really collateral tied to an open position. Others calculate risk from the margin posted rather than from the total position value, which leads them to underestimate losses. It is also risky to assume all assets follow the same margin rules, because Forex, stocks, indices, and more volatile products can differ a lot. Brokers may also raise requirements when markets become unstable, shrinking your cushion without any change in your original trade idea. The disciplined habit is to leave room above maintenance and to expect that rules and market conditions can tighten at the worst possible time. Section 3. Margin calls. A margin call happens when losses reduce your account equity below the broker's required minimum level. In other words, the collateral supporting the leveraged trade is no longer large enough for the position being held. The broker then requires you to restore the account, usually by adding funds, reducing the position, or closing trades. The key threshold is the maintenance margin, not the initial margin used to open the trade. Because your deposit is serving as collateral, falling below that maintenance level signals that the broker's risk has risen too far. A margin call is therefore not just an alert message, it is a sign that the trade structure is breaking down.